This point refers to a requirement directly from IAS 16 when we had a revaluation on a depreciable asset. You must remember that it's necessary to eliminate or offset the asset's accumulated depreciation against its cost when you value adjust or revalue this asset at date of acquisition. We did exactly that when we had a revaluation on a depreciable asset in IAS 16. You had to offset the accumulated depreciation against the gross carrying amount of the asset. Because we now account for this value adjustment through a consolidation journal entry, we still have to follow this principle from IAS 16 as it's on a depreciable asset. Remember, the reason for this is that the fair value of the asset at date of acquisition represents the cost of this asset for the group, and the consolidated statements should therefore reflect only accumulated depreciation on this asset since the date of acquisition. You will see the effect of this when we do example 7.9. P Limited acquired a 70% interest, so I have NCI of 30% in the net assets of S Limited on 1 January 20X9, being my acquisition date. On 31 December 20X10, please read carefully. The trial balance of each of the companies reflected the following balances. I have property, plant and equipment buildings, 150,000 Rand, and accumulated depreciation buildings, 70,000 Rand. The investment in S in the books of the parent is 120,000 Rand. The share capital of S is 122,500. I have my retained earnings opening balance as 107,500 Rand. I have profit for the year of the subsidiary of 130,000 Rand, and please just note that depreciation on buildings, which will be included in profit for the year, is listed as a separate line on this trial balance. On 1 January 20X9, being the acquisition date, the identifiable assets and liabilities of S were considered to be fairly valued, except, remember, the moment you see that word except, you know you are in chapter 7, you are busy with IFRS 3 business combination valuation adjustment journals at acquisition date. The buildings of S were undervalued with 20,000 Rand at acquisition date. It is the accounting policy of S Limited to account for buildings in terms of the cost model in IAS 16 property, plant and equipment. The moment you see that, you can now conclude S would not have accounted for that 20,000 Rand at acquisition date in its separate financial statements, as its accounting policy would not allow for that. Depreciation is recognized on the straight line basis over the useful life of the buildings with no estimated current residual value. The remaining useful life of S's buildings on 1 January 20X9 on acquisition date was 10 years. The cost price and accumulated depreciation at acquisition date amounted to 150,000 Rand and 50,000 Rand respectively. Just so that you can analyze your trial balance, that 50,000 Rand was the accumulated depreciation at acquisition date. From the trial balance, you can see the annual depreciation by S is 10,000 Rand. How did the 50,000 then change to be 70,000 Rand? That's why it's so important that you read your headings. The trial balance given here is at 31 December 20X10. Therefore, since acquisition date, 2 years have passed, so 2 years depreciation of 10,000 Rand per year has been added to the 50,000 Rand at acquisition date to give you the 70,000 Rand accumulated depreciation in the trial balance. The retained earnings of P Limited and S Limited amounted to 37,000 Rand and 7,500 Rand respectively on 1 January 20X9. So that is the at acquisition retained earnings of S. It is P Limited's accounting policy to account for investments in subsidiary at cost in its separate financial statements. So the carrying amount on the trial balance provided represents the cost of the investment. The directors of the parent have chosen to measure my non-controlling interests at their proportionate share of the net assets of the subsidiary at acquisition date. Because the trial balance is given is at the end of 20X10, we now follow the consolidation process at the end of 20X10. There's no adjustments necessary for different reporting dates and accounting policies. We combine the balances and totals on the consolidated financial statements. And now we have to identify the business combination valuation journal entries at acquisition date, and we'll use the suggested work method to identify them.